Good morning. This is Japanese Economic Review Channel. Today we analyze the dramatic market divergence observed on May 15, 2026. While the U.S. markets reached historic milestones, the Japanese market faced a sharp correction. We will explore how geopolitical easing in the West and macroeconomic tightening in the East created this unique decoupling effect, and why the headline drop in Japan doesn't tell the whole story. The numbers are striking. On May 14th, the Dow Jones eclipsed the 50,000 mark for the first time since February, and the Nasdaq hit a new record high. Conversely, on May 15th, the Nikkei 225 plummeted by over 1,244 points, closing at 61,409. Despite this, the USD JPY remained steady at 158.35, suggesting that the volatility was driven by internal equity dynamics rather than currency fluctuations. This matrix illustrates the opposing forces at play. The U.S. rally was fueled by geopolitical easing and buying the news regarding AI export expansions. Japan, however, faced a sell-off triggered by rising 10-year JGB yields, which forced a recalibration of high-flying tech valuations. While the U.S. saw a broad tech-led lift, Japan's indices were dragged down by a concentrated group of mega-cap stocks. The catalyst for the U.S. surge was the Trump-Xi summit in Beijing. A major policy shift was announced. The U.S. granted permission for approximately 10 Chinese firms to purchase NVIDIA's H200 AI semiconductors. This anticipated revenue expansion, combined with robust earnings from Cisco Systems, propelled the Nasdaq to its record close of 26,635. In Tokyo, the narrative was dominated by the gravity of rising yields. As 10-year JGB yields climbed, the valuation premium for AI and tech stocks became harder to justify. This led to aggressive profit-taking. The Nikkei opened with buying interest but quickly succumbed to pressure, bottoming out with a massive 1,716-point intraday drop before a slight recovery at the close. Here's the most critical insight. The 1,244-point drop was a breadth paradox. Despite the headline decline, 857 stocks on the prime market actually rose, while only 674 fell. This indicates that the sell-off was not a systemic panic, but a highly concentrated correction of overvalued AI and tech heavyweights that disproportionately affect the Nikkei index. Sector-wise, the pain was felt in non-ferrous metals and chemicals, with giants like Sumitomo Electric and Shin-Etsu seeing declines. However, underlying strength remained in specific industries. Companies like Hamamatsu Photonics and DEC Cereals gained ground, showing that investors are still rewarding individual corporate merit despite the macro-level index drag. The emerging markets mirrored this selective environment. While stocks like Cogent Bio faced selling pressure, others like Unairy and THECOO attracted capital inflows. This reinforces the idea that we are currently in a stock picker's market, where individual catalysts and growth stories are more influential than broad index trends. Beyond the charts, corporate Japan continues to innovate. NEC has launched a subsidized space transport project, and DIC is expanding its physical AI footprint in Zurich. On the consumer side, we see seasonal agility, from Don Quixote's cooling blankets to Cocos's summer menu launches. These micro-level developments signal long-term structural health. In conclusion, May 15th was not a day of panic, but a day of repricing. The U.S. market is capitalizing on geopolitical openings, while Japan is navigating a painful but necessary recalibration of valuations amid rising rates. The underlying breadth of the Japanese market remains robust, masked only by the heavy weighting of a few retreating AI leaders. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.